Mhm.
Fine. You have reached Angel Ayala with Keller Williams. Please leave your name, phone number, and I will get back to you as soon as I can. Thank you and have a great day.
Good afternoon. Good afternoon, Joseph and Sharon.
Good afternoon, Mr. Perez.
Good afternoon.
Good afternoon. Can you both hear me okay?
Yes.
Okay, great. So we'll give it a few more minutes, allow folks to start joining. Good afternoon, Pam. Miss Cheyenne. Guess we'll give it 2 more minutes, then we'll start. Just to be respectful of everyone's time.
Hey guys, thanks for jumping on. So I'm going to introduce Perez. So Perez is a tax consultant. And I probably messed up the actual title, but he is a wealth of knowledge. He's going to teach you a lot of different topics today. Just enough for you to be dangerous, but obviously enough for you to be able to get your client over to him as well for that professional advice. But he's going to be able to help you understand some different tax situations and some options that your clients may not think of. And I think this is really going to be important for you because you'll be able to have enough information to kind of guide them and maybe get them on the right track, right? So if somebody's on the fence about buying long-term versus short-term rentals, that's a great conversation for you to have with Perez, right? Or if they want to know, hey, what's the best investment vehicle? I have this lump sum of money. What should I do with it? Well, they're looking to you as, a professional. He's going to be able to help guide you a little bit more. So I think it's going to be really good use of time. So I appreciate you guys jumping on. Thanks, Perez.
Okay. Thank you so much. And again, I definitely want to thank Angel. Thank you for allowing me to speak to your team and to your group. Again, my name is Perez Goree, CPA, certified tax coach, and owner of my practice, Perez Goree and Associates. One of our niche markets is offering accounting and tax strategies to real estate investors. So Angel and I have been talking the past couple of weeks about different things that real estate agents may want to consider, may want to think about, and probably some things that you are hearing in the market. Because the market is a little bit different, say, today than it was 5, even 10 years ago. So I kind of want to open today's session out with what is the craziest tax question you heard while working with a client or showing a client. Again, the goal is not to make you a CPA. We're not going to be talking about tax revenue codes. We really want to expose you to some of the common conversations either you're hearing or you're likely to hear while you're showing clients properties and working on real estate deals. So again, I want to kind of ask you guys, we want this to be as interactive as possible where you're not just sitting here listening to me lecture for an hour. So I just want to open it up to you guys initially to ask, what are some of the tax questions you're hearing as you're showing clients properties, and how comfortable do you feel in answering those questions? So I'll open it up to you, whoever wishes to answer.
Can we discuss 1099 exchange?
Oh, the 1031 exchange. Okay.
There you go. Yeah.
And how comfortable are you with having those types of conversations?
Not very.
Not very. Okay. So we can touch on some of those subjects. And again, we don't want to make you CPAs, but we just want to just kind of raise your level of awareness with the types of questions you're going to have and how to best navigate those discussions. And I kind of want to start my presentation by sharing my screen. And tell me if you can see a presentation.
Yes.
Yes.
It's called Navigating Investor Conversations. I'll move it over here.
Hi, Perez. Are you sharing? I saw something and then it went. Oh,
Okay,
okay. There you go.
here it is. Mhm. So this is kind of what I was talking about, where in the past, when I bought my home, been in my home for about 10 years now. And when we were buying, what's the old saying? Location, location, location. Some of the main things we were concerned with are what the location is, what the price is, what types of schools are in the area, those sorts of things. And today, if you're buying a personal home or if you're working with investors, I guess that's another question. How many of you are working with investors, or how many of you are working with folks who are just buying a home for themselves to live in personally, or do you kind of have a combination of both?
A combination of both.
Yeah, combination.
Okay. Because what we're seeing are a lot of buyers and investors, from the business side, they're asking more tax related questions than ever before. Uh, Particularly, some investors are even coming to me with tax strategies, or they're asking me if certain things can work. They may say, well, I checked out a YouTube video, or I went to a seminar, and can these things work for me? So I'm assuming you're getting those types of questions, and we just want to help you, navigate those conversations better. And
Definitely. I have a scenario that just popped up yesterday. After talking to you,
okay,
you gave me lots of insight and knowledge. I had a client that said, hey, I'm going to make more money in the stock market than investing into this multifamily unit. And I said, well, the returns from an annual basis could be a little bit better, but what about depreciation and offsetting your income and, those other tax benefits? And she was like, oh my God, I didn't even think about that. She goes, this outweighs the returns way more so. And I said, absolutely. So, once
right,
once I was able to paint that picture for her, she was all in, right? So she was on the fence about making an offer and going full price, asking price rather. And as soon as I mentioned how much more she'll save from a yearly basis versus the returns and plus the appreciation of the property, it was a slam dunk. So that simple conversation turned into a 600 and I don't know $45,000 purchase price, right? So this is why this information is really helpful.
yes. When you're looking at investments and you're investing your money, one of the components of your return on your investment are what are the tax consequences? How much are you going to pay in tax on the profits from your investments? That is a component. A lot of times it's a big component of the investments. So you really want to have a good understanding as to when those opportunities present themselves and what to say and what not to say. I guess it's best to, if you don't really know and you really can't answer something with confidence, it's best to say, hey, you know what? I'm not really sure on that. We may have someone that can help you, with that, rather than just giving a flippant answer to keep the conversation going, or keeping the engagement. Again, I just really want to kind of try to walk a mile in your shoes. How do you feel when say a prospective client you're showing properties to are having or asking you of these types of questions? Do you have a strong sense of answering the question, or do you just try to avoid it and steer the conversation to a different direction?
I think I tried to follow up and help, like some of my buyers have asked about, especially those who are interested in short-term rentals. They want to find out more about capital gains and like Angel said, like expenses that they can deduct. But I try to get some expert help versus just ignoring it, right? Because that doesn't help you. It doesn't make you look professional.
Okay. So that's kind of what one of the goals that we want to achieve today is to increase your value in the eyes of your clients, where you're becoming the person who can offer some, not necessarily advice, but offering them some answers to questions, or kind of directing them in the right directions with those questions. So kind of jump into the next thing. How many of you are hearing some of these types of questions? Can I write this off? Should I put this property in LLC? Can I write off these losses? What's the difference between the short-term and long-term rentals? When are capital gains relevant? And the big one that we hear a lot on our end is, how could I use these cost segregation studies to help me? So, again, what are you hearing?
All the above. We're getting all that stuff. I would say we're getting, the depreciation is probably the number one thing that I hear from prospective clients. LLC versus a trust, always. Write-offs, not as much. Usually we just kind of say, hey, like most things are going to be a write-off, defer to your tax, specialist.
Right.
Not many people know about cost segregation, though, in my opinion.
Okay. Are those conversations coming up to you, or are clients asking you about those? Because we're going to touch on that quite a bit today.
I'd say a combination of both.
Okay. Got it. Because sometimes, you may be caught in the middle, and we don't want you to feel like you're stuck, because these are kind of some of your pressure. We don't want you giving bad advice. It's better to give no advice than giving bad advice. But sometimes, in an effort to close the deal or to keep the client engaged, people may answer questions for the sake of answering it, but that may end up biting the person in the long run. So, are you aware of what some of the liabilities could be if you're giving advice and they're taking that advice and it's not turning out properly for them? Because I'm highly aware of it from my end, and I have to be very careful in the words that I use, the things that I say when I'm talking to a person, because I don't want a person to say that I've gave them advice and they took it and ran with it, and it didn't turn out the way that they wanted it to. Because it's very hard giving advice when you don't know the specifics of a person's situation. Sometimes a person, they try to give you as little information as they can, and then ask you, well, can I do this? Can I do that?
Oh yeah, absolutely. And they
Use
only need you when they need you, right? So they don't
Yeah,
give us a lot of details either.
the best answer that I usually give is perhaps. Perhaps you can. Maybe you can, but I don't know enough about your situation to say one way or the other. Should I be an LLC? Should I be an S corporation? Should I do this? Should I buy long term or short term? I don't really know. And you have to be okay with saying that and not feel pressure to give an answer just for the sake of giving an answer, because you really don't know. I don't know enough to say. I need to sit down with you and understand what your long term plans are, um, to say anything that's worthwhile. Because I don't want a client coming back to me saying I gave them bad advice. So you want to be as guarded as possible, and the best answer is perhaps that might be applicable. You might want to get some tax advice before you execute that strategy, because I'm a real estate agent. I'm not a practicing uh, tax professional, so I don't feel comfortable giving you that answer, because I have to do the same thing from a legal side. I get a lot of legal questions that clients ask me, what's the best asset protection strategy to use? Well, I'm not a practicing asset protection attorney. I mean, I know some things, but I'm not going to advise you in that arena, because I would get slapped on the wrist very hard with the state for practicing law without a law license. So you want to be guarded with the information that you're giving. And that's basically what we call is the rules of engagement. This is how you can confidently navigate these conversations. And you're not stepping too far out of bounds with giving advice. And you can speak with confidence, but you have a support system or a network or a group of professionals that you can reach out to or refer clients to get certain questions answered. Um, Again, we don't want to just give advice for the sake of giving advice. So we want to touch on this, and we'll kind of expand upon this a little bit. These are, we call this kind of like it's a game, if you will. It's to say this and not that. So we call it red light, green light. And I'll ask you a couple of other questions outside of what you're seeing here. But these are some of the things that you'd never want to say as the real estate agent. You don't want to give any specific advice. I'm sure you got these questions. Should I put this property in the LLC? Should I put it in a trust? So when you get those types of questions, we're saying don't get that specific advice. You say you acknowledge that question, but that's more of an advanced tax strategy, and there's folks out there who can answer that question for you. And you definitely don't want guarantees, because I don't even want to give guarantees unless I know all the specifics of the situation. So you don't give a guarantee. You don't want to project the specific tax outcome. If you buy this property and you do a cost segregation study, you could save $30,000 next year. And then you're speaking with confidence as if that's really going to happen. So you would speak kind of in broad terms. You may be able to do a cost segregation study, but it makes a difference. Is it long-term rentals, short-term rentals? It just depends. And again, you don't want to explain exactly how depreciation works. Let me ask you exactly, what is depreciation? How does that work? How can I help my tax situation? You just want to acknowledge that yes, depreciation does exist, and it may be able to lower your taxes in your situation, but you really want to seek the guidance of tax professionals that know the particulars of your situation. And I'm going to ask you guys a series of questions. I like to call this, can you say that? So I guess you can give an indication with a thumbs up, thumbs down, on your end. And I'm going to read a few scenarios and you kind of ask me or let me know what you think. Can you say, absolutely, you should definitely buy every property inside of an LLC? Good answer, Sharon. Uh, can you say different investors may structure properties differently depending on their goals? Mhm. Okay, I'll ask maybe two more. You need an LLC because it lowers your taxes. Good answers, Jeffrey and Sharon. That's right. But let me ask you a question. Do you know why you shouldn't say that?
Because I'm not the expert. I don't know.
Okay.
I don't know their entire situation. Just saying that without all the information, I'll be guessing.
Yep. In my world, they would call that gross negligence. If I don't know your situation, but I'm like, yeah, you can do that. You can save a lot of money if you do that strategy without knowing the particulars. You border on gross negligence. If you're trying to advise somebody about something you have very, very limited knowledge on. Okay. Let's keep going. But you do want to do this. Smart agents, you're not waiting for the questions. You're recognizing when planning opportunities exist before the transactions occur. Like coming to sessions like this, and you start to hear about what are some of the things you're likely to be asked during a session working with a client. As you get more exposure to that, you can start being prepared and anticipating what types of questions you're likely to be asked, and even more importantly, how to answer the questions. Um, you can answer them with confidence, and the more confidently you can answer a question, and you're not giving bad advice, you're becoming more and more of the trusted advisor to that client. You want to be their trusted advisor where they come to you and they're seeking advice, and you're kind of giving it to them the best you can without steering them in the wrong place. And from what we're seeing, these are three types of clients who need immediate tax planning. High income professionals that are buying real estate, first time real estate investors, or investors that are selling highly appreciated property. What types of clients are you working with, or do they fall under any of these types of profiles? Or what types of questions are they asking you if you have that? Like sometimes we're working with medical professionals. They have a full-time job. They have their high-paying W-2 employees. So they would kind of be in the first group, high-income professionals. They're purchasing investment properties. They're in a high tax bracket, and they have passive income limits. So a person may have high W-2 income, and they will come to us with something like, "Hey, I heard if I bought some rental properties, and if I did a cost segregation study, I may be able to write off a lot of losses against my W-2 income. Is that true?" you might hear a question like that. And the way I would respond to that is, it depends. I don't know enough about your situation. Are you buying long-term properties, short-term rentals? Are you a real estate investor? Do you qualify as a real estate professional? I don't know enough. That's the best answer I can give. And then I would say maybe we should sit down for a tax planning meeting to learn more about the particulars of your situation before we can even answer that question. And yesterday, I received a call from a prospective client who's looking to get into what do you call it when you're flipping contracts, a wholesaler. So he's in the process of starting a wholesale business. He's never been in business before. He said, I'm very good at sales, but I'm not sure about all the tax implications of doing wholesaling as a business. And he started to ask a lot of questions. Can I write this off? Can I write that off? Just kind of let him know some things that you may be able to write off, but let's have a full blown meeting to understand what your long term goals are. Because what we do is we make sure that your long term. First, we'll know what are your long term plans for building wealth. That's more of a personal finance question. Then we make sure that your tax planning or your tax strategies are in alignment with what are you trying to accomplish long term. Because without knowing that, we may be advising you on strategies that go against what you're trying to achieve in the long term. And others who are selling highly appreciated property. How long have you held the property? Is it long term, short term? There could be a lot of tax implications. And you're probably hearing about those 1031 exchanges. I've heard someone mention that earlier in today's session, that clients may be coming to you with, hey, if I sell this property with a 1031 and do a 1031 exchange, can I avoid taxes on that? How would you answer that question if someone came to you with that? I bought this property 4 years ago. I bought it for $150,000. Current market rates say that I can sell it for about $450,000. I'm looking at the capital gain. What if I did a 1031 exchange on that property? Will I have to pay tax on that? How would you answer that question? I think you got it. It depends. I don't know.
Perhaps.
Let's go next. You're probably hearing a lot about this, or if not, you definitely will. Well, how many of you heard about last year? Was it July 4th, the big, beautiful tax bill that was passed? It basically reinstituted 100% bonus depreciation on certain things. So that
Can you
made
clarify
these
what
cost
bonus depreciation? I'm sorry, Perez. Can you clarify bonus to depreciation?
Yes. What bonus depreciation is basically the opportunity for you to accelerate your depreciation. It doesn't create new expenses. Like, for example, if you buy a long-term rental property as an investor, you typically get to depreciate it over 27 and a half years. What bonus depreciation is you can bust that property up or segregate it into different components. So like lighting fixtures, flooring, You're breaking down the components of that property, and those components, rather than waiting 27 and a half years to expense it, you could expense it now 100% this year. Say if you bought a rental property in 2026 for $200,000, rather than expensing the $200,000 over 27 and a half years, you bust that $200,000 up into its components. Maybe 30, 40,000 of the building is, let's see, you can break it up into the kitchen components, the refrigerator, the stove, flooring, and those things you can depreciate over 5 years rather than waiting 27 and a half years. So it's kind of a bonus, meaning the bonus is you're pulling expenses from future years into this year. And we want to know, is that the best way? Is this the best time to do that?
Perfect. Thank you.
So that's really the crux of what a cost segregation study is. You basically want to move your expenses from the longer term categories into the shorter term, like here, 1, 3, 5, or 27 and a half years. And I believe the next slide goes into a little more detail. So this is kind of the picture of a property by itself as is. And in the past, you would depreciate that over 27 and a half years, the whole building. But what we want to do is segregate the costs into its various components, like this section of the house. So instead of saying the whole property, I'd use a $200,000 number as an example. Instead of depreciating the entire building of 200,000 over 27 and a half years, let's bust this property up into its components. Some of the components are flooring. Some of it is appliances, lighting, landscaping. These components have shorter lives. So you can expense that. And going back to your bonus depreciation question, if all of these components were worth $50,000, you could expense $50,000 this year rather than waiting 27 and a half years. So that might make sense if you anticipate having larger profits. Maybe you sold the property this year with a large capital gain, and that could help offset it. But without knowing a person's full picture, we can't advise you if you should or if you shouldn't do this. We don't know yet. But a client may come to you. I went to this seminar and I heard about cost segregation studies, and I think I'm going to do one. Do you guys think it's a good idea for me to do so? I would say I don't know. I don't know all your particulars. It may work, it may not work.
Would
do
you
you
say
qualify as a real
generally
estate professional?
speaking? Would you say generally speaking, they are more beneficial for people, like in just most general sense? I know
Not
everyone's situation is
necessarily, no,
different, but okay.
because there's a rule called passive loss limits. Passive losses means you're not actively engaged in the real estate business. You just bought a long-term rental property, but you kept your full-time job. So you're working 40 hours a week on your job. You're not really spending any time with this property other than collecting rent and dealing with the occasional calls that may come up from your tenants, or you maybe hire a property manager to manage the property. By default, when you buy rental properties, the IRS considers that passive income or passive losses. And you can't offset passive losses against your W-2 income. But if you are a real estate professional, you can, because as a real estate professional, you're considered as this is your line of business. Like if, say all of you, if this is your primary means of income is selling real estate, you would be considered a real estate professional. if this is all that you do. So I couldn't just tell a client, yes, generally speaking, the cost segregation study can benefit you. Because I need to know, well, how do you make your living? Are you a real estate professional? Or no, you're not? Because these losses might be limited. Because what I see is a lot of real estate investors go to different seminars, and those seminars are hosted by people or businesses who offer cost segregation studies as their line of business. Now, we actually do those at our firm. We do those for our clients. But before we even get into that conversation, I want to confirm if you could even use it. If I know you're a real estate professional, maybe you can. But those clients go to these seminars and they buy these packages, $5,000, $10,000 for this cost segregation study kit. And the person that sold them that kit will not be around when the tax return is filed. They're going to come see me, and I'm going to say, you're not a real estate professional. We can't write those losses off against your income. And they're frustrated. But the guy or the girl at the seminar told me I could, but they're not filing taxes. So you can't just make a blanket statement that, yes, the cost segregation study can benefit you. You really want to confirm how they make their income. It depends. And again, these are a lot of the components that go into that decision. So you're not going to get specific advice about a cost segregation study. Because also there's a loss limit where even if you could write off these losses, you are a real estate professional. If you're single, I think 26, you're not getting too specific. If you are a single taxpayer with passive losses or even active losses, the most you can write off is $300,000 in any given year. And if you're married, it basically doubles. You can write off $600,000. But maybe the person just heard, well, I can write off all my losses. I'm going to generate $1 million worth of losses from doing all these cost segregation studies. And they think they're going to write all that $1 million off, and they can't. The most they can write off is $600,000. And now they're frustrated because they only got 70% or 80% of the picture. They didn't realize there was a limit on how much you can write off in any given year. So you want to know all the specifics before you advise. Any questions? I'll ask you guys a couple of questions. Kind of a Q&A session. Let's go here. Ask you a series of questions, just kind of bring up the monotony a little bit. What's the common misconception investors have about rental property deductions? That's what they think. If I can have an even better way to do it, let's go here. And see if you can answer these questions. Now that we just talked about cost segregation studies a little bit, what's the primary objective of performing a cost segregation study? You can just answer by typing into the chat. That's that. You're breaking it down to its components. Maybe one more. Which of these is identified as a common misconception that real estate investors have regarding rental properties? I'll give you a hint. Investors typically assume. Okay. How much of the expense? So let's see, I got it. Thanks for that, Jeffrey. Investors believe rental properties only provide small deductions each year. That's because they think that they're only going to depreciate a property over 27 and a half years. So it's going to take a long time to expense that amount, and the deductions would be small. That's the misconception. Because the cost segregation study can generate massive write-offs. I worked with a client last year. What did they do? They bought 5 Airbnbs in Central Florida. They were high W-2 income earners, almost 7-figure income earners, and they generated a lot of losses by buying short-term rentals. And the wife qualified as a real estate professional. And they were able to use cost segregation studies to generate over $600,000 of bonus depreciation to offset that high W-2 income. But that's only a one-time deal. You can't do it every year, but they knew that this last year was the year where their income was going to be at its highest. So it's timing. Because when we're working with clients, we're looking over a 3-year horizon for tax strategies. What is your income going to look like this year, next year, and the year after that? Just because we can do a cost segregation study doesn't mean we're going to do it in 2026. Maybe 2028 might be better because you know you're going to sell off some properties. And you're going to have a large capital gain in 2028. So we might hold that strategy until a future year. So even me, I wouldn't answer a question where should I do this cost segregation study? And I know it could work. I know you're a real estate professional. I know how much you can write off with the loss, but maybe 2026 is not the best year to execute that strategy because I also know in 2027 and 2028 what your income is going to look like because we are proactively planning. We're not just looking at 2026. I might say, yes, we can do the strategy this year, but because you're going to be in a higher tax bracket in 2028, higher tax bracket, i.e. higher percentage, you're multiplying that deduction times a higher percentage 2 years from now than you would this year. So let's not waste it and use it this year unless you really want to. That's what advising is all about. Just because we can do something doesn't mean we will do it. It's just the best year to do so. Come back here. So ultimately, what the goal is today is to kind of build an advisory team, if you will, where they have you as the real estate agent and you're the expert in the market. You have ideas of what the market is trending towards. Is it a buyer's market? Is it a seller's market? When will things change? We try to become, for you, a go-to person when you're getting those complex tax questions that you don't feel like answering. We could be a resource or a source outlet for you to either answer some of those questions on your behalf or steer the clients to us to help you answer some of those questions because you're getting those. Even on my end, when I prepare clients' tax returns, they take my tax returns and they feed those through Tax GPT. They come back to me and tell me you missed a deduction. I said, I really wouldn't trust the advice of what ChatGPT is saying, but this is the market we're working under, where your clients are coming to you after doing their own homework. And if you're not sure and confident in what you're doing, they'll be advising you. So you really have to know what you're doing, knowing what you can do and what you can't do, and how to steer your clients in the proper direction. So a lot of times I don't answer tax questions if I don't know the particulars. So we would say bring that client to a qualified tax strategist who's looking at their situation more holistically. Because a lot of times your clients are just looking at you for this specific transaction, this property they want to buy or they want to sell. Well, they want to know what's the tax implications if I do that. Well, we want to look at your whole picture. What is your spouse's income? What is your income like? What's over the next 3 years? We don't want to just give an isolated advice on a specific transaction without knowing the total picture. So, again, you want to protect yourself. You want to have better investor conversations. You can start anticipating what those conversations might be like. And you recognize when there's planning opportunities, based on, say, the 3 types of investors we talked about earlier. And it could help you build stronger client relationships where the clients don't feel like you're just giving them flippant answers or you're just ignoring them. And I kind of just want to open the floor up at this moment. I'll kind of open the floor to any types of questions you have.
Absolutely. That was great, Perez. And where can we reach you at? Do you have like a phone number that we could reach you at? Email address?
Yes. Let's see. I can put it here in the chat. I'll put both. And our goal is to simply educate our clients. Our position is clients don't want to buy. Excuse me, clients don't want to be sold, they want to buy. Meaning present me with the information, give me time to digest it, and let me come to my own conclusions as opposed to me bombarding you with information. And
And what do you see are the main things that real estate agents like us are reaching out to you for questions on?
Depreciation, bonus depreciation, what's the benefits of long-term rentals versus short-term rentals? How can we properly execute 1031 exchanges? Or, well, that's one of the answers, but how can my client avoid huge capital gains? They bought this property 5 years ago. It's really appreciated in value. Now they want to sell it, but they're fearful that they're going to get hit with a large capital gain tax bill. What can we do to avoid getting hit with all those taxes? That's usually the biggest one.
Capital gains after a large sale, appreciation.
Yep. Because what we want to know is, do you need the cash? Do you plan on cashing out, taking the money? Or do you plan on rolling it into a higher value property and just keep trading up in value? Was that Monopoly game, 4 green houses equals 1 red hotel? Are you just going to keep trading up, or do you need the cash? So you can't just say, yeah, you should do a 1031 exchange, because they might need the cash to, hey, I sold this property because my daughter's going to college. I need college tuition now.
Mhm.
So offering a cost segregation, not cost segregation, but offering a 1031 exchange wouldn't be the best advice because you can't touch the money with a 1031 exchange. Since you're rolling your equity into a higher value property from each transaction, but the cash can't touch your hands. So if I advise you for a 1031 exchange, but you really need the cash because you're trying to fund your daughter's college tuition, I gave you bad advice. Because I'm just looking at it from that isolated transaction. I need to see your whole picture. What are you trying to accomplish? Oh, had I known your daughter going to college, I wouldn't advise you of that. Well, maybe I should have asked that, or I should have dug a little deeper to know what their overall objectives are before giving that advice. So but I understand your position because they're asking you questions specific to that transaction that you're working with them on, that piece of property or those multiple properties you're showing them. And that's more of a limited view. You don't know the whole picture of what they're trying to accomplish. I mean, it might be good advice for that specific transaction, but collectively overall, maybe not.
Right. Definitely. No, that's good. That's good to know because we definitely go into these. We definitely get these questions, and it's good to have somebody that we can speed dial right there and get our clients connected to the right person to get the right answers, right? Because we want to establish long-term connections with people, and last thing we want to do is give them bad advice. You don't want to steer
Because you
people
got
the
to see
wrong
them
way.
again.
Yeah.
Yep.
Absolutely.
And the way we work at it is we say when we're giving our clients advice, we're saying if you do this, if you do this, if you do this, if you do that, this is how much money you could potentially save. And when we file your tax return, that's our report card. Okay, well, how well did we advise you? I've been talking this talk all year. If you do this, now let's file the return. Did you really save that amount? And my daughter, she just graduated from college, so college tuition is high on my mind right now. Well, I'll tell her in school, 95% is great in the classroom. But me telling you, I did your tax return 95% right. That's not quite good enough. Doing the 95% right can get you a letter from the IRS. So you want to be very guarded in your words and what you're saying and how you're saying it, because everyone wants somebody else to blame when things go wrong. And it's
Absolutely.
always the accountant or the attorney's fault, usually.
Yeah. Awesome. And the last question for me is what fees, like if we send them over to you, what does that look like in terms of, what you charge them and stuff like that?
We don't have a set price, but what we would give them is a free consultation, a free analysis, where we would say, let us see your prior year taxes. We're doing this all complimentary. We're just looking it over for missed deductions, missed opportunities. And we would say, give us about a week and we'll come back together to explore tax strategies that may be able to save the clients, money, significant money. And if we can't save clients, usually the benchmark is about $15,000 to $20,000 a year, we wouldn't even try to onboard them as a client. We're not going to take clients' money if we can't save them significant dollars. We're moving away from standalone tax preparation, where how much you charge to file a tax return. We're getting out of that line of work, because what I'm seeing is there's AI tools that can file a tax return now. There's AI tools that can do bookkeeping. We're moving away from just standalone tax prep. So if we can't save you significant dollars, the best we can do is file a tax return for you. And that's not the line of work we want to be in 5 years from now. But we do file the tax returns for the clients we do tax planning for, because that's how you hold us accountable for our advice. We don't want to give you this advice but you go see someone else to file the tax return, now we're not accountable for advice. But we do give them a free analysis, and if we decide, or we both mutually decide, meaning the client and us, we decide we're not a good fit to work together, at a minimum, they got their taxes analyzed and they got some recommendations on how to improve their taxes.
Absolutely. Awesome. And did you put your contact information in the chat?
Yes.
Okay, perfect. There it is.
I'll copy it and paste it again.
Yeah, I see it. Perfect. Beautiful. I'll go ahead and put that in our group chat. Yeah, I'll go ahead and put that in our group chat. Angel had to jump off to do
I
something,
understand.
so covering for him. But yeah, does anybody else have any questions for Perez? I know we're getting to that hour mark. I know some people have to jump off.
Yep.
But
everybody has to get back to work. I understand it.
yeah, absolutely. But Perez, thank you so much. We're going to go ahead and drop your information in the group chat for all of our locations. Really appreciate your time with this. And you'll definitely be hearing from some of us here soon, because a lot of us, probably all of us, work with investors from time to time, not just, people buying for their family. So, it's really good to have a trusted person that we can call and send our clients to, and just, send a seamless connection there. So thank you, Perez.
Right. It's definitely my pleasure. And you all have a great and prosperous day.
Thank you. Absolutely. Take care.
Alrighty. Mm-hmm.
Bye-bye.